Hey, what's up? Liquidity Hunter here, and for today's video, we're gonna be talking about the basics of crypto trading. Crypto trading is one of the fastest growing ways people try to make money online today. But if you're new to crypto, terms like spot trading, futures trading, long positions, and short positions can sound complicated really fast. So in this video, we're going to simplify everything. We'll cover the basics of crypto trading, the difference between spot and futures trading, what perpetual contracts are, and one of the most important concepts beginners misunderstand. Trading is not about predicting the future perfectly. It's about projecting probabilities. And unlike investing, traders can potentially profit whether the market goes up or down. So, let's get into it. What is crypto trading? At its core, crypto trading is the act of buying and selling cryptocurrencies to profit from price movement. The most common cryptocurrencies people trade are Bitcoin, Ethereum, Solana, XRP, and many others. Now, many beginners think trading is simple. You buy low, then sell high. And yes, that's part of it. But modern crypto trading is much broader than that, especially when you enter futures trading. Before we talk about futures, let's first understand spot trading. Spot trading is the simplest type of trading. When you buy crypto on the spot market, you actually own the asset. For example, if Bitcoin is trading at $100k and you buy at 0.01 BTC, that Bitcoin belongs to you. If the price goes higher, your crypto increases in value. If the price drops, your holding loses value. Simple. Spot trading is commonly used by beginners, long-term holders, and investors. The main characteristic of spot trading is you profit mainly when price go up. So, if Bitcoin rises from $100k to $110k, you can sell at a profit. But what if the market is crashing? That's where futures trading becomes popular. So futures trading allows traders to speculate on price movement without actually owning the cryptocurrency. Instead of buying actual Bitcoin, you're trading a contract based on Bitcoin's price. This changes everything because in futures trading, you can go long or go short. Going long means you project the price will go higher. Going short means you project the price will go lower. And this is where many beginners misunderstand trading. Professional traders are not trying to predict the future perfectly. Trading is about projection, probability, and the most important one is the risk management. Now, no trader knows exactly what will happen next. Instead, traders analyze market structure, the volume, momentum, SNR, and other strategies. Then, they create a projection based on probability. For example, a trader may believe Bitcoin has a higher probability of moving up from a support zone. The trader enters a long position. But another trader may see weakness in the market and enter a short position. Both traders are simply projecting different scenarios. That's why trading is not gambling when done properly. It's probability-based decision making. Now let's move on to what is perpetual futures contract. A perpetual contract, also called a perp, is a type of futures contract with no expiration date. Traditional futures contract usually expire at a certain time, but perpetual futures can stay open indefinitely as long as the traders maintains enough margin. That is the most common type of futures trading on exchanges like Albank. Perpetual futures are extremely popular because they allow long positions, short positions, and leverage. Now, leverage is important to understand. Leverage means borrowing capital to control a larger position. For example, with 10x leverage, a trader with $100 can control 1,000 position. This increases both potential profit and at the same time potential risk. Because leverage magnifies gains, but it also magnifies losses. That's why risk management is everything in futures trading. Let's simplify long and short positions. If you long, you want price to go up. Bitcoin is at $100,000. You enter a long position. Bitcoin rises to 105k. Your position gains value. Now in shorting, it's the opposite. You want the price to go down. Example, Bitcoin is at 100k. You enter short position. Bitcoin grabs to 95k dollars. Your position gains profit from the decline. This is one of the biggest differences between trading and traditional investing. Investors often rely mostly on markets going upward over time, but traders can potentially profit in both directions. Bull market, long opportunities. Bear market, short opportunities. Sideways market, indecisive opportunity. That flexibility is why many traders are attracted to futures market. So, why most beginners lose? Now here's the reality. Futures trading looks exciting on social media. People post huge profits, luxury lifestyles, fast gains, those Lamborghini and such. But what many beginners don't see are the risks behind the scenes. Most beginners lose money because they trade emotionally, skip the risk management, they don't know how to use leverage or to position size properly, they chase the hype or FOMO, or try to predict every move perfectly. Remember, the goal is not to always be right. The goal is to manage risk while following high probability setups. Even professional traders lose trades regularly. The difference is they manage losses properly. So to summarize, spot trading means owning the actual crypto asset. You mainly profit when prices rise. Futures trading means trading contracts based on price movement. You can profit from both upward and downward moves. And perpetual futures contracts allows traders to hold positions without expiration while using leverage. But the most important lesson is, trading is not about predicting the future with certainty. It's about predicting probabilities, managing risk, and reacting to the market. Whether you go long or short, successful trading comes from discipline, strategy, and emotional control. Thanks for watching, and if you learned something from this video, don't forget to like, subscribe, and share this with someone trying to learn crypto trading. For our next video, I'm gonna be talking about the different strategies or technical analysis traders use in futures trading. And also, I will share to you what I personally use.